Assalamualaikum class. In this video, we can discuss the cash flow estimation of capital budgeting. So here is our topic is assignment topic is a case study of Hirshleifer company. We can discuss its question and its numerical. Firstly, we can discuss its numerical pattern and then we come to the questions. So first, this is a replacement decision. Firstly, we discuss the all document tax basis. We purchase it 2 lakh and depreciation 1 lakh tax basis. Remaining 10 lakh tax on the sale 1 lakh 20,000. We sell it and we gain on 20,000. So we calculate its tax. The tax calculate formula of is tax rate. We can multiply 20,000 is our gain with the tax rate. So that is the cash outflow. We can minus 18, we can calculate multiply with the 3500, the 70,000 is the cash outflow. If we sell this equipment after 5 years, we can receive 10,000, but we lost this opportunity. We sell it initially. So if we sell after the 5 years, we can pay 35 taxes, so we can save it. So when we purchase a new equipment, the purchase cost is 33 lakh, depreciation charges to 28,2700, 2,28,720. Tax base is 1728 because we can charge it on makers method. The expected sale price is 1 lakh. So tax basis is remaining amount is 17,000, so we can gain on 22,000. 2,000 over our gain. We can multiply it with the 35 to calculate our tax. That is it. And the working capital, then initially that is our asset 1 lakh, asset 1 lakh, but after when we sell it, there is a cash outflow. So we can calculate the total investment cash flow to plus all the cash flows. So our total investment cash flow is here. So we can calculate the change in operating cash flow. So we can calculate the operating cash flow. The change in expense is 0 in all the years, but the expense is plus 60,000 because we purchase a new equipment. So our expense is less in 5 years. So we can calculate the depreciation method. We can calculate the new equipment with the makers percentage method of 5 years. So there is a formula of makers method. We can multiply the purchase value with 20%, that there is a year depreciation percentage. So we can depreciate it all equipment with a straight line method. There is equal amount in every years, and we can minus both because we can sell the old equipment. So we have 20,000 is of cash inflow, so minus it cash outflow. That is our formula. You can see it. So we can calculate the change in taxable income by plus minus of revenue, expenses and depreciation. That is our taxable income. We can find it every year and we drag this formula. Yes, then we can calculate the tax on our income. Our income is 20,000, so we can multiply it with the tax rate and minus, because that is a cash outflow because our income is positive. So in this years we can pay 7,000 over tax, but next year the company will remain in loss. So we can we have our tax subsidies in that years because we are in loss. So we can pay. So we can save cash 56,000 in that years. That is our tax shield. To change in taxable after our income, we can minus tax income with our taxes, and we drag that formula and add a depreciation in it. Depreciation is same when in our when we minus in upper, so we can add it. We can calculate the depreciation and add it in, and that is our operating cash flows. and we track this formula in all the years that is same. And then next and last step is net cash flow. The net cash flow is the plus investment cash flow and operating cash flow. So in initial years, our cash flow is same in the end, and operating cash flow is also same. But in the last step, we can add operating cash flow with the investment cash flow. So we can see. So we can discuss the answers with related of our case study. Now question number one is problem statement. The replacement of answer is the replacement of old equipment with new equipment, the asset acquisition and disposition, and what cash flow would result for each of the five fear for this replacement. It is discussed in our numerical. So the question number two: what are the various investment decisions involved in this project? There are three type of the decisions are involved in three in this project: the replacement of old equipment, the purchases of new equipment, and analyze the operation cash flow. Question number three: explain both the new investment and asset disposition decision. New investment decision involve evaluating and allocated resources to a new project or asset expected to generate future return. This included analyze profitability, risk, and market condition. Asset disposition decision, on the other hand, focus on the sale to or dispose of an existing asset that may no longer be profitable or needed. This involves accessing current market value and future cash flow to optimize the organization asset portfolio. Question number four: what are the effects of depreciation on the tax in the case of a new acquisition and asset depreciation? In the case of a new acquisition, depreciation expense reduce taxes. In the asset disposable, we should pay tax in the case of a gain or capital gain. We already discussed in the numerical. The question number five is: are there any tax credit on the acquisition of any new equipment? No, there is no tax credit on the acquisition of a new credit. Question number six is: is this project so question number six is this project a new acquisition project or replacement project? This project evaluating the replacement of its existing manufacturing equipment with the new equipment. The question number seven is how the equipment will be depreciated over the life of the project. Explain in detail. No equipment will be depreciated over their own life. Note their project life. There are two type of method involved in the case: straight line method and Macker's method. Question number 8: what are the cost implication of the old equipment? Will there be any gain on its sale? Whether the gain will be a capital gain or a recapture gain. The old equipment cost is 22 lakh 5 year ago. Currently, their tax basis is 1 lakh depreciated on the straight line method. Old equipment sold on 1 lakh 20,000. So our gain is 20,000. This is a recapture of a depreciation. Question number 9: is there any sunk cost involved in this project? The 2 lakh old equipment cost is our sunk cost because it is irrelevant cost. Question number 10: what are the different cash flow involved related to a tax in the case of disposition of the old equipment? There are two tax related cash flows. Selling the old equipment today result in the tax 7,000 cash outflow. If we sell after the 5 years on 10,000, over cash inflow is 35,000, 3,500. So question number 11: if the firm replaces the old equipment today, what will it forego after 5 years? If the firm replaces all equipment today, it forgone the sale of equipment in 5 years for 10,000. So tax inflow of 35,000. Question number 12: what are the already benefit of the company will earn in the case of reduction in expense when the new machine will be installed? The new equipment expected to reduce production cost by 60,000. So we already discussed in the numerical form. Question number 13: why there is no effect on the revenue due to the charge in new equipment? In the case installation of a new equipment may not affect the cash flow. It depends on the specific financial circumstances. Question number 14: explain the depreciation tax shield received by the company due to this investment. Depreciation tax shield received in the investment because on that year our expenses increase, so we pay less tax, so we receive the tax shield. Question number 15: how manager practically make important decision? The estimate cash flow based on the factories like sales, expenses, taxes, and working capital need. Question number 16 is: what are your key learning after reading this text? After reading this case study, we learned this point: asset disposal process, asset acquisition, tax basis, and depreciation method. So we can complete all the questions.